YouTube channel. So I have come here with a new video on introduction to mutual funds. So before go into the video, please subscribe to my channel so that you get notification on new videos uploaded by me on stocks and mutual funds that will be useful for you in your investment journey. So let us go to this video directly. So I will give you a brief introduction on mutual funds. So by definition, a mutual fund is a professionally managed investment scheme usually run by an asset management company that collects money from investors and invests in their money in equities, that is stocks or debt securities like bonds or other securities like gold. So investors actually gain based on the growth of value of investments in the fund. And normally mutual funds initially collect money from the public via new fund offer, that is new fund offer. They are actually initially, most funds actually issue mutual funds at a price of 10 rupees, and it is also possible for investors to buy funds by invest in mutual funds after they are listed, after a mutual fund is listed. And it is not necessary that we can invest in a fund only via new fund offer. And depending on the money collected by the fund manager in the new fund offer, the fund manager will invest the money in appropriate investment category based on the type of fund, be it equities, debt instruments or gold, etc. And the asset management companies or the mutual fund companies in India are regulated by Securities and Exchange Board of India. And there is an organization or the Nodal Association of Mutual Funds. It is called AMFI. The full form of AMFI is Association of Mutual Fund Industry of India, and they provide useful knowledge and insights regarding mutual funds and investments to investors. So in their website you can actually see the details regarding new fund offers and the NAVs of all the mutual funds that are listed in exchange in the market that are available for investment by investors. Okay, so I will give an introduction of the type of different asset management companies that are allowed to raise funds in India from investors. So one of the oldest asset management companies, Axis Mutual Funds, HDFC Mutual Funds, Kotak Mutual Funds, ICICI Prudential Mutual Fund, Aditya Birla Sun Life Mutual Fund, UTI Mutual Funds. Actually, UTI Mutual Fund is one of the first mutual fund house that actually started raising money from the investors in '92, where the UTI Master Share and Master Gain. And then we have SBI Mutual Funds, DSP Mutual Funds, then L&T Mutual Funds, Sundaram Mutual Funds, LIC. Then actually there are some other old mutual funds like Principal Mutual Funds, Taurus Mutual Funds. Earlier, actually, Taurus Mutual Funds had a good subscription there. They are through their mutual fund called as Taurus Star Share, but they are not actually collecting money recently through their new fund offers recently. So there are some new entrants like Franklin Templeton Mutual Funds, IDFC Mutual Funds. Then we have some older entries like Tata Mutual Funds. Then we have L&T Mutual Funds, LIC Mutual Fund, JM Financial. They are all recent entries that have been existing in the last 5-10 years only. And we have the mutual fund promoted by public sector banks also, like BOA, AXA Mutual Funds, the Union Mutual Funds, like that. And okay, so actually like that, the Nippon Asset India Mutual Fund is a mutual fund house that was initially promoted by Reliance, Anil Ambani Group. So since they actually sold the entire stake to Nippon India, so the Nippon India is actually the main promoter of Nippon India Mutual Funds. So they have renamed their funds from Reliance Mutual Funds to Nippon India Mutual Funds. So okay, this is an overview of the different asset management companies in India that are allowed to collect money from investors for investing in mutual funds. Okay, then let us see what are the different types of mutual funds. So we have two types of funds, that is one is open-ended funds and one is closed-ended funds. Open-ended funds, advantage by the name, we can actually invest in the fund anytime, either in NFO or after the fund is listed. And the closed-ended funds, we usually have a lock-in period, say 3 years. So we can only invest in the time of NFO, and we cannot actually redeem or withdraw the money within a period of say 3 years in the fund. So actually one advantage of closed-ended funds as compared to open-ended funds is that the fund manager actually gets a lock-in of 3 years to invest the investors' money in the right type of stocks. So there is no risk of redemption. So the returns in closed-ended funds are normally higher than the open-ended funds, because in open-ended funds, investors may actually withdraw money at regular intervals. Can withdraw money at regular intervals. Then there is a term called net asset value. That is the net asset value actually represents the fund's market value, or funds per unit market value. So this is the price at which investors can buy funds of a mutual fund company or sell it back to the fund house. For example, if a company actually issues a new fund offer, it will be normally at a price of 10 rupees, and based on the investments made by different investors over a period of time, suppose the fund manager collects more money, he will invest in more stocks, and the net asset value of the fund may increase from 10 rupees to around 15 or 20 rupees. So 15, suppose if the net asset value fund is actually currently 15 is the price that the investor needs to pay to buy a 1 unit of that particular one quantity. So if we want to buy 1000 units of that particular fund, we need to pay 15,000 rupees. For example, one fund, that Mirae Asset Emerging Blue Chip Fund, that was initially launched in 2010 at an NAV of 10, has a current NAV of 59 based on the different investments made by different investors by SIP route and lump sum route. And so the investors, the fund manager invested more money in more equities, and the fund value actually grew to around 59 in October 20. So around 490% returns have been given by that fund in 10 years. So let us see what are the different types of plans of funds. There are two types of plans. One is the regular plan. If you are actually investing in a fund through a broker or financial advisor, it will actually have some higher expense ratio. So that type of plan is called regular plan. If you are actually investing directly without any financial advisor or broker, that particular fund has a lower expense ratio, and that is called direct plan. The regular plan, the NAV of that fund is will be higher, lower, because it has higher expense ratio, and some commission will be given to that broker or financial advisor for investment made by us. In direct, since there is no intermediary, broker or financial advisor, NAV is normally higher. For example, if SBI Blue Chip Fund is actually having an NAV of 30 in regular plan, the NAV in direct plan would be around 33 or 32. It will be higher as compared to regular plan. But one thing is that if we actually buy unit, we need to pay a higher NAV, and if you sell the units, we'll also get the redemption at a higher NAV with a lower cost for direct plan. So if you are actually comfortable with analysis of a particular fund, we can actually go for direct plan. Otherwise, if we can actually seek the help of a broker or financial advisor and invest in regular plans. Then we can see what are the different options for funds. That is growth. There are two options of funds, that is growth fund and dividend option fund. So in the growth funds, the fund value of that particular fund is not distributed to shareholders in terms of dividend, and it is actually reinvested in the funds. For example, in the growth fund, suppose if I am actually investing in SBI Blue Chip Fund or HDFC Balance Advantage Fund Growth or SBI Blue Chip Fund Growth, suppose the fund is actually having investment in Infosys might declare a dividend. So that dividend, if that will not be distributed to shareholders, it will be actually further reinvested in the fund. Whatever dividend is given for that investment in that particular fund will be reinvested in the fund, so that the growth, the NAV of that fund will rise. So in the growth fund, the fund value is actually not distributed to shareholders in terms of dividend, but it is reinvested in the fund to have higher NAV. But in the dividend options, investors can actually get periodic dividend payments which are declared by the fund manager. There are two sub options like dividend payout, where the fund the investors can actually withdraw the money through directly to a bank account that is linked to the fund, or they can actually reinvest the dividend to buy more units. For example, NAV of dividend funds are actually lower than growth fund, because NAV will actually drop when a particular fund declares dividend. For example, HDFC Balance Advantage Fund dividend, it's actually having an NAV around 20 rupees, but it actually declares a dividend every month. So suppose it declares a 10% dividend every month, so NAV will drop 0.20 for that particular month, and further months it will actually drop 0.2 again. So the NAV of that particular fund will be always lower than growth fund, because for the growth fund the NAV will be periodically increasing, even if the dividend will be actually, fund value of the dividend will be actually added to that particular fund. and see what are the different categories of funds. And there are two categories of funds. Different categories of funds. One is equity funds that invest in shares listed on stock exchanges. For example, SBI Blue Chip Fund is a equity fund that invests in shares listed on the stock exchange. Like it will invest in companies like TCS, HDFC Bank, LIC, L&T, etc. Then we have another subcategory under the equity funds, that is hybrid funds, which actually invest in a balance of equity and debt. That is around 60% equity and 40% debt. Then we have mid-cap funds which have a good percentage of 30%, 40% investment in mid-cap companies, and small-cap fund that have a good percentage, around minimum 30-40% investment in small-cap companies. And then we have large-cap fund that we have a major share of investment in the large-cap equities, like top companies in the market. And we have then sector specific funds like technology funds, pharma funds, tax saver funds. Technology fund means a company that invests in the technology space, like companies like TCS, Infosys, like that. Then we have banking and financial services fund that invest in the public banking sector, like HDFC Bank, private banks like HDFC Bank, PSU banks like SBI, like that. Then we have tax saver funds. Tax saver funds actually used by investors for tax saving purposes. That particular investment will be having a lock-in of 3 years. So that investment, whatever investment maybe, it is eligible under tax reduction under Section 80C. And then we have other category of funds called debt funds. So debt funds actually invest the money collected by investors in debt instruments like NCD, bonds, etc. Then they have lower returns as compared to equity funds, but there is no risk of reduction in capital because they actually invest in AAA rated securities like NCDs, bonds, etc. In this debt funds also there are subcategories like gilt funds, bond funds, and other debt funds like NCDs, bond funds, and debentures, etc. And then there is another category called fund of funds. So the fund of funds actually is a fund that invests in other types of funds that include a portfolio of equity funds, debt instruments, gold, etc. The fund of funds is actually a mutual fund that actually invests in different types of funds. It is a mutual fund that is invested in other mutual fund. That is, it can actually include a portfolio of equity funds, debt instruments, gold funds also. Because some fund of funds will actually invest in both a mixture of both equity and debt and gold also. And these are the different categories of mutual funds. Let's see other important information related to mutual funds. One is the investment amount. For example, if you're actually investing in a mutual fund for the first time, the investment amount is normally 5,000 rupees. But if you're actually already invested in a particular fund, I want to invest more, the additional investment that is possible is normally around 1,000 rupees for a particular fund. But we can actually invest in higher multiple like 1,100, 1,200, etc. And there is no roundabout. We can actually invest from 5,001 rupees or 5,002 rupees. So it is up to us to how much we want to invest. There is another option to investment, that is systematic investment plan. If you opt for a systematic investment plan, if we actually apply a systematic investment route, a periodic investment amount, say 5,000 or 2,000 rupees, will be deducted from our bank account linked to the mutual fund on a specific day. So the specific day is actually, it depends on the fund. For example, Kotak Mutual Fund may set 5th, 10th, 15th and 20th as the day in which the investors can invest by SIP route. So if you are actually investing through that particular fund, and if you are actually choosing an SIP on 20th, an amount of say 2,000 rupees will be deducted on that particular month if you are actually opting for an SIP of 2,000 rupees. And the minimum amount that we can invest in SIP is normally 1,000 rupees, or some mutual funds it is 500 rupees. But it actually depends on the funds, on which days we can actually invest by SIP route and how much we can invest. The minimum investment amount we can invest by SIP. That depends on our savings, or what kind of returns we want to have in a period of 10 to 20 years. Then we have a concept called systematic withdrawal plan. If you opt for systematic withdrawal plan, we can actually periodically withdraw a specific amount for a specific period. It is just opposite of systematic investment plan. So for example, if you want to invest 1 lakh in a particular fund, and you want to in equity fund, and you want to withdraw 800 rupees per month, we can actually open a systematic withdrawal plan to set a specific day, say 20th of each month, we can actually withdraw that amount. This is particularly important if you actually investing in a debt funds, where we can actually get an assured return of around 8 to 9 percentage. We can actually invest in a lump sum amount of 1 lakh rupees and opt for a systematic withdrawal plan of 800 rupees per month, so that we get around 8% return. That is similar to returns we get from fixed deposits. Or the minimum investment that depends on the funds, and is normally around 500 rupees for some L&T funds, but L&T funds like L&T mutual funds. But for some other mutual funds related to Sundaram, etc., it is around 1000 rupees. Then you see what are the advantages of mutual funds versus direct equity. So the advantages of the mutual funds versus direct equity is actually professionally managed by a fund manager who has vast experience in the equity markets, and they actually invest in a basket of securities, so the risk involved in a single stock is reduced as compared to direct equity. And there is a good liquidity also, because we can actually redeem or withdraw at any time, and the amount will be credited in 5 to 7 days for equity funds, and for balance fund it will be credited in 3 days, and for liquid funds and debt funds we can actually get it within 3 days. The sufficient securities are also possible, because there is no foul play possible, because redemption would be done to only the bank account linked to our mutual fund. So let us see what are the advantages of equity funds or debt funds. Debt funds has low risk as compared to equity funds, because they invest only in debt instruments like bonds and CDs, but they give a return of around 7 to 9%. Equity funds are expected to give higher returns around 10 to 15% or even 20%, but there is a risk of market fall in equity funds, and if you are actually investing in the high market levels, there is a risk of loss in equity funds. So but that risk is not there in debt funds, because they are actually similar to bank deposits in that they give around 7 to 9% return. Normally around 8% returns you can expect in debt funds over a period of 1 year. Equity funds is as mentioned by me, equity funds over higher returns compared to debt funds, but they will actually give around 10 to 15% returns, and they can give higher returns if we are actually willing to invest more on market corrections. And equity funds also a reduction in fund value below the invested value if the investment is made during a market high, because the timing of investment is also sometimes critical for equity funds. If you are actually making the investment at the time market high, we can actually need to invest for stay invested for a long term basis, or will be willing to buy more on the market correction, so that we get an approximate average value, so that we can actually sell at a higher rate when the market recovers in future. So these are the basic info of mutual funds. I will actually take you to an example of one particular fund where the investors had made a lot of money over the last 10 years. That is Mirae Asset Emerging Blue Chip Fund. So this particular fund was actually started in 2010, and its current NAV is at around 59 rupees. So an investment of around 1 lakh rupees made in 2010 is worth around 1 lakh rupees is around 5.9 lakhs in the current level. That is a returns of around 490% in the period of 10 years. So that actually explains the advantage of mutual funds as compared to other investment categories. So it is not possible that the same kind of returns will be possible for all funds. It depends on the type of investment being by the fund manager, what type of equities or stocks that the fund manager buys. But we can actually expect that a good return is possible if we actually invest in the right kind of fund. So I will show a typical example of what kind of returns are given by this particular fund, the Mirae Asset Emerging Blue Chip Fund. So it actually NAV goes from around 10 rupees in 2010 to around 20 in 2015, and the current NAV is around 59. So even if I actually assume 58%, the NAV comes to around 52 in 2020. So considering the same return, if we have made around investment at SIP from 2010 onwards, our total investment would have been around 48,000 per year, and the total investment over a 10-year period is around 5,28,000. So considering the average purchase price of around for each year, the total units we would have bought is around 24,194, and the current market value is around 59 rupees. So the fund value currently is around 13.7 lakhs for an investment made over a period of 10 years of around 5.2 lakhs. So if we can actually expect the same kind of returns over the next 10 years also, the NAV of this particular fund will actually grow to around 323 in 2030, and the fund value should be around 83 lakhs for a total investment around 10 lakhs. So that is a huge return for investment made of only 4,000 rupees per month. So the for the only total investment of around just 10 lakhs. So there is a power of compounding in mutual funds, where every mutual fund advisor advises invest to invest a surplus money, so that this amount can be utilized for the investors for their future requirements, taking into account the inflation that will be existing at that particular time. So even if we actually invest in a SIP route, if we are actually investing in a new fund offer at the price of 10 rupees, not considering that the Mirae Asset actually given 18% return, if you are actually just assuming 10% return, an investment, if you are actually making an investment of 4,000 rupees per month, the total investment would be around 10 lakh 80,000 rupees, and the fund value would be around 50 lakh rupees, assuming just 12% return every year. So the fund values, the NAV would actually of that particular fund that is currently issuing at 10 rupees would grow to around 133 in 20 years. So that explains the power of mutual funds. If you like this video, so please refer to the give a subscribe to my YouTube channel, so that I can actually post new videos for the benefit of investors. And please refer to the disclaimer on this particular page also before exiting from this video.